Morning, everybody, and thank you for joining us today again for our last session of the financial statements. We are having a few people that's still joining, but I'm going to start so long because the first bit is always just a little bit of admin. So today with me again is Angela. I'll be taking you through some areas, but then as we mentioned in last week's session, she will also finalize the cash flow and go through that with you as well. So again, everybody's muted. Please use the chat function if you have any questions. Like as today is the last session, we will also have a little bit of a Q&A at the end. If there's anything else that you want us to cover or show, we can also do it in that. Signals lost, please exit and enter. We don't have that so much with Teams anymore. And then the recordings, so we have uploaded the recording 1 and 2. There is a little bit of a challenge just to get these recordings uploaded, but we will be working on it, and recording for the previous session and this session will hopefully be made available to you very soon. So the agenda for today is we're going to have the case study wrap up. So we're going to start with the tax computation. I'm going to take you just through it. It's a very quick exercise, but it's something that we have quite a few support calls on. So we thought it would be beneficial for you to also go through that. Then Angie's going to take you through the last bit of the cash flow worksheet and the cash flow statement. Then I'm going to take you through the iXBRL, and then we're going to go into consolidations. Like I've mentioned in the last session, if you have consolidations as a firm, you'll have a specific code that you need to enter to activate it. If you want to do it with me, if you don't have that code in your firm, you're more than welcome to still stay on. We will go through it, and it's just that element of the console that you won't be able to do, but you're still welcome to stay in the session and learn. Then our last week's winners, we did decide that unfortunately, if you've won once, you can't win a second time. But the winners for last week was Lolene Strauss and then Alyaya Adam. I hope I pronounced that right. So congratulations. At the end of the sessions, there will be a team in contact with you, or your account manager will reach out to you. The assurance team still have quite a few sessions. I think they're still going on for 3 weeks. So it will be probably end of April, closer to the time that they will be in contact with you. And then, like I mentioned, today is the last session. And from my side, I just want to thank you for everybody for joining and sticking with us. And with that, I'm very sure you do know where your resources are. Again, the QR code, if you want to find it. There is an Excel file uploaded for session 4, which is the consolidation, journal, and TB. So you can download it now or in one of the breaks. You won't need anything else for the sessions before that. Right, with that, let me just switch off my camera, and then we are going to start with the tax computation. So what I want to ask you to do is the file that you've been working on with Angela, the Get Ahead file. If you can open that file, and then we are going to start by processing a journal and then looking at the tax computation. So I'm going to give you like a minute or two just to open that file. Okay, I believe you have it open now. I have also put in the chat the link to the material, same link every time, but if you maybe have missed it, you can also find it there. Right, so in the file that you've done with Angela, there's now a TB included. You've gone through some of the changes, and now we're going to look at the tax computation. So what I want you to do is, if you go to your adjusting entries, and you click on new, you're going to process a journal for me. So I'm going to do this unrecorded one. So I've already processed, just so you can see. And let's say what happened is you've drafted your financials, you've sent it to the client, it's gone back, and you've realized the auditors had looked at it and realized that there was a payment made like on the 28th or the 28th of February, and this haven't gone through your bank account yet, so you need to account for it. And the journal that you have here is your paid source, and the amount is the 15 million. So I'm going to process this journal, and I want you to do the same. So you can process a normal adjustment, and those are your account numbers. So remember, your file is rounded, so you have to put in all the zeros so that it's in your TB, and then we are going to see how the tax computation look. I'm just going to give you a minute. Open your file, process the journal as you see on screen, that you are on the same page. And if you're done processing it, then you can open your financial statements. Right, so if I go to my balance sheet, if I now scroll down a little bit, you'll see here I've got a current tax receivable of the 15 million that I've just processed. And then if I scroll to the income statement, I have a tax of 0. So no tax has been accounted for. If I then go to my tax computation, which is at the bottom there, then this is at the back of your financials. Some clients prefer to print it separately. They send it to their clients, or some of them print it part of their financials as a supplementary information. So how it works is it pull through your net profit per your income statement. You have the option to switch on the prior year or not if you would want to, which is this button here. And you have also the option to switch on your references or not. Then what you can do is you can type in your permanent and your temporary differences. So this is like your added back expenses, difference between your tax rate of depreciation and your accounting rate of depreciation, which you can then type in here. And then what happens here at the bottom is you have your capital gains tax, local and foreign. And then here you have your calculated tax profit for the year. So I'm just going to quickly type, no, I'm not going to quickly type a figure. We're happy with a 904. That is my profit for the year. Then you have two undefined differences. The first difference is this difference here. And what that is if I look the 904 and then my tax rate is the 27%. Now remember that percentage you can type in your information store. So if you're doing a different region or the tax rate might change, then you'll go to your information store and you'll change it there. And then it calculates the 244 on the 904. And I believe all the accountants in the room will take the calculator and quickly double check me, but it is the 904 times 27% give you the 244. And then it gives you an undefined difference. Now this undefined difference is the one that's in the income statement. So if I quickly jump back, you don't have to, you can stay there. It is this figure here. So I'm quickly just going to open the note because I just want to show you the deferred tax element while we are there as well. So I have 0 tax. My client didn't account for any tax. And if you look at the income statement last year, they have a loss. So they probably felt like they didn't anticipate to have a tax amount. Let's just quickly get the note open. Right. So you'll also see in the top of your taxation note, you have some links here that will take you to your tax computation and the information store. So if you click on that, we'll jump to the back. This will open your information store. If you then open this section of the note, which you'll normally have on if you have tax in your file, you'll have your current tax and deferred tax in this section. Now that recon at the back looks at the current tax figure, right? So it looks at this figure here and it says, is there a difference between the two? So if I go back to my tax computation, yes, there is a difference between the two because there is 0 tax and here it's saying my tax should be the 244. So I need to pass a journal for the 244 so that it is correct. So that's the first section of your tax computation. Then you jump into your second section, that is your tax balance. And it's actually sometimes easier to first do your tax balance before you look at the income statement, but that's completely up to you. So remember now, the 244, you can clearly see that's per the calculation. So this is purely this 244, but now it gets to the bottom and says, okay, that is what you have to put into the financials. But then you have now also another amount, which was the journal that you've processed, right? So if we go back to our journal, it was the 15720, right? And if I go back to my financials, so 15720, and I can say that was my first provisional payment was the 15720. So why, oh, sorry, that's a negative. And why that doesn't pull through is because, remember, you just have your TB imported. You don't have your transactions. So we won't know what your payments was during the year. As soon as I put in that payment, now you can see that my outstanding balance is the 244. So because these two agree, it would be very simple to pass this, and it would be you pass your journal to your current tax and then to your source balance, and then you will see that this will clear. And you're welcome to do that if you want to give it a try. But what is very important to also note, if I go again to my tax note, is say those 244 balances, which is now very clear that it's the same one and it's an easy fix. Say they were not the same, then you'll have to understand on what is causing the difference. So it can be a few things. Firstly, it can be that there was other items that's in your SARS balance, and that's sometimes the easiest to pick up, was there may be interest that you didn't account for. So if you get your SARS balance of accounts from them, you can put in the different lines of what you need to account for there. Or if you get the GL, you can put the accounts that you put in there. If there's still a difference, if you're very sure that your tax SARS balance is correct, you've put in all your transactions, but there's still a difference between the two, then most likely it's because of deferred tax. Now, our clients normally don't have, or a lot of them don't have a current tax and a deferred tax, different accounts for them. So they just put all their transactions into one account. So it might be that you need to pass a reclass journal between your current tax and deferred tax. And remember, your deferred tax balance sheet can only have your income statement as the contra account. So how to make sure that your deferred tax is right, and this file now doesn't have deferred tax in, but if you take your movement on your balance sheet, the only net of that journal can be your income statement deferred tax. So as soon as your deferred tax are correct, then your current tax normally are also correct. So start with your balance sheet, then you move to your tax computation, make sure you have all your lines in there, make sure your tax journals are processed, and then it should balance at the end. Right, I'm just going to double check. Is there any questions before I hand over to Angela to look at the cash flow statement? Any questions on the tax computation specifically? Just going to give it a second and see if anything comes up. It doesn't look like it. So Ange, I'm going to hand over to you for the cash flow.
Thank you, Ninka. Good morning, everybody. I mean, it's Thursday morning, it's cash flow statement. Where else would you rather be? What else would you rather be doing? Okay, I'm just going to quickly share my screen with you. And I'm going to give you a second to make sure that you can see it. Please some thumbs up if you can see my screen. There we go, I've got one, perfect. All right, so I've opened up the same set of financial statements, except mine don't have the tax journal that Ninka's put through. You can follow in yours, or you can just follow on the screen and watch me. It's not going to be a problem if we have slightly different trial balances. You should still balance out in the end. So where we left off last week is that our statement of cash, I'm just going to close this to just remind you how I got here. So currently I have clicked on CF to get to my cash flow statement, and I've opened the little robot to show, or the balance check, to show that we left off last week with us cash flow statement out of balance. So I just want to take you back through that journey. You will recall when we first started this set of financial statements that the cash flow statement in the beginning was completely out of balance. And I explained to you that for the current period, there would be no amounts in the cash flow statement when you first open a new file, or when you first open the file for the current year. And the reason for that is because the cash flow worksheet, the cash flow statement current year, populates from the cash flow worksheet. So you won't be able to put amounts in to the current year column without actually completing the cash flow worksheet. So you will notice my current year column doesn't have any yellow cells, which means that you cannot type over them, with the exception of the one subtotal balance there. So when you first open your file, the cash flow worksheet needs to be you need to refresh to link up the cash flow worksheet and the cash flow statement. So you'll remember that was the first step that we did last week. We clicked on the refresh button, and what it did is it brought in all the figures that were available. And at that point in time, you'll remember we did that step before I had completed the reconciliation for property, plant, and equipment. And at that point in time, if you remember, if you weren't stealing a quick cup of coffee, there was no balancing difference. So it was in balance for the current period. So you would normally find, depending on your transactions, but in 98% of the cases, you will find that when you refresh straight away after you've imported a balanced trial balance, your cash flow statement should be in balance. But remember that a balanced cash flow statement is not a complete, accurate cash flow statement, because within there you could have potentially non-cash movements, and those have to be stripped out. So what the mechanism does, and I'll go into the cash flow worksheet in a bit, is that as you complete the other sections of your financial statements, for example, reconciliations of movements, the cash flow worksheet pulls in whatever non-cash balances or movements it finds in those other locations. So a good example is transfers of property, plant, and equipment to another class of asset. A transfer is a non-cash movement, so it would have grabbed that transfer amount and put it into the worksheet. It also grabs non-cash movements which are in the trial balance, like depreciation, amortization, impairment, foreign exchange, gains and losses on fair value adjustments, and the list goes on. So when you're so this is why, as we went along processing the notes, our cash flow statement went from being in balance to being out of balance, because only one leg of a cash flow of a non-cash movement was processed. I'll explain that in a bit, just park that thought. Okay, so I'm going to show you how we're going to make the current year balance. I just remind you, for the prior year, only in the first time that you do the financial statements for this entity, because it takes a lot of, it's more than just that, but mainly because it takes a lot of space. The cash flow worksheet's quite a large document because it's calculating your cash movements. We only put one cash flow worksheet in the file for the current year. So also to save you from having to go and redo the work to create the prior year's cash flow worksheet. So there is no prior year worksheet to pull the amounts through from, only in the first year. So for the first year, you're going to take out your previous signed off financial statements, and it's going to take you like 2 minutes or less to just type in the prior year amounts, and obviously make sure that they agree to the signed financial statements, but you will get your balance check will go in balance for the prior year if you've done it correctly. You're only going to do this in the first year. So next year, when it's 2027 and you roll forward the file, all of these 2026 amounts in the current year will roll forward into the prior year column. So this will become 2026, obviously, and all these amounts will move over. So you're not going to type in your prior year every single year. Okay, so it's just that once off, and like I said, it's literally a very short exercise to get it done. So now, having said that, let me go and show you how to work the cash flow worksheet. So Just one more thing. It's a good exercise to periodically click refresh, because as you've done work in the financials, or if you've imported another trial balance, refreshing it will just link everything up again. Okay. So I'm going to go and click on my cash flow worksheet, the little button above, and it's going to open up that worksheet for us. Right, I'm going to take you now through this. So this is literally, as it says, a worksheet. It's a place for you to work out, to save you from having to do your work in Excel or scribbling on a piece of paper or whatever your favorite approach is. So how it works, we've got, as you're used to by now, we've got our document map on the left. You see there's our document map key. And then we've got the actual cash flow worksheet on the right. So there's a few sections. And if you're in group, as you would see if you were in a consolidated file, this would just be duplicated, and you would have company, everything company, and then this would be a duplicate for group afterwards. But the same principles apply. So the first part is the actual cash flow worksheet. What you see here is a whole lot of blue text on a gray background. When you see that, it means it's guidance. And guidance means please read and understand. It doesn't mean I don't need to be interested and move past. So please do read through that. It will help you understand how to populate this worksheet. But probably 85% of the work is already done if you have just mapped to the right places. And then the only thing that you're going to have to concern yourself with is finding non-cash movements which are not obvious from the trial balance or the other notes. And you would concern yourself with just double checking the classifications. But otherwise, most of the work is done for you already. So I'm going to take you, so the very first part is the worksheet, and the logic behind this is it's laid out. You can see I'm standing on the statement of financial position. So it's laid out as a statement of financial position, where the approach that we've taken is to take all of your balance sheet or statement of financial position line items. So we started with assets, excluding cash and cash equivalents, because this is the cash flows worksheet. So we're trying to work back to that. So it lists all of our line items as you would find them on the statement of financial position. And then we subtotal at assets. And then we go on with our equity and liabilities. So we start off with our share capital, reserves, and so on. And obviously, you would expect there to be no cash movements against something like reserves, right? So, or not, against reserves. So if you see a zero at the end, you're quite happy. Then we've got our retained income section, which is essentially our net profit. Those of you who hopefully will all agree with me that the movement, or a significant part of the movement in retained income, should be your net profit or loss. So we've taken this retained income item. This is essentially our net profit. And then we've taken out our non-cash items included in profit or loss. So it starts to feel a bit more cash flow statement-y now. So it's all our non-cash movements that are in the income statement. And then we take out our items which are separately disclosed, like interest and dividends and taxation. So this is where we take them out, and then this is where we put them back in to disclose separately. And then we have all of our liabilities. You see loans from group companies, trade and other payables, and so forth. So all of our assets and liabilities and equity are listed. And the objective is the movement is just the subtotal of everything above it. And then we take the movement of everything and we compare it to the movements in cash or cash equivalents. And ultimately, we should get a zero balance here on the end. It might be out by 1 or 2 on this worksheet, and that could be because of rounding, especially when you've taken, like we've done, a rounding by thousands. You're obviously going to be 1 or 2 out. This part of the balancing is fine because this is not the actual cash flow balance. This is just to make sure that our full balance sheet, we've identified only cash movements. But now let me show you. So I've shown you that the layout is balance sheet. I'm going to just go back to the top, and I want to show you the logic that we apply. So we start off with the opening balance for every balance sheet item. And then we've got an array of columns. So starting at transfers and reclassifications and all the way up to items requiring separate disclosure. So we've got all these non-cash movements. And then we say less closing balance. And then we say that should then equal the cash movement for that account. And that should make sense to all of you. So what you're going to have to do, what your process will be, is to double check what is here and to identify any missing components. So in our non-cash movements, you will see a lot of yellow cells and you will see some white cells. The white cells, you obviously know that you can't change, and they all pull through from mapping numbers. The yellow cells, a lot of them you will just type in the amount manually, or they may pull through from somewhere, but yet you've got the ability to type over them. So if I look through the columns, I just want to mention that the column that you use to put your amounts in doesn't actually matter. This is literally a worksheet. This is just for your audit trail or your accounting trail, whichever way you're looking at it. And so it's not going to pull through to somewhere if you use the wrong column. Okay, it was just to help you keep your mind around what the amounts in the various non-cash movements are for. So in this case, so we've got transfers and reclassifications. This is as easy as it says. Obviously, if you transfer between assets, or even if you transfer between reserves, you'll use this column. Non-cash capital additions and removals. So this is like if you receive capital assets and it was, for example, donated, you didn't actually pay for them. Business combinations, obviously you would have movements in your assets and liabilities through business combinations that would show as non-cash, because the actual cash movement would be through the goodwill line in the end and the non-controlling interest line. Through other comprehensive income, that's OCI. So that's like if you've got revaluations that would have impacted property, plant and equipment, that would be a non-cash movement. Then we've got a through profit or loss, non-cash. This is automated. So these would typically be things like depreciation, gains or losses on disposal, some foreign exchange. These are items which the system is able to actually identify from the trial balance. And that's what's important when you do your mapping, that, for example, depreciation, you don't just drop it anywhere. If it's depreciation on property, plant and equipment, put it in the property, plant and equipment category in the mapping, so that it lands in the right place in the cash flow worksheet. Otherwise, you're going to have to manually go and put items in the right yellow cells. If you want to know what's made up of this 522, you can just right-click it and click Trial Balance Drill Down. And it's on my other screen, so I'm just going to move it across. It brings all the accounts that were used in that line. So you can see our opening and closing balance. You see that we've got all these accounts. Those are all the balance sheet accounts. So if I want to know what was in the profit or loss section, I'll look at the income statement accounts. And I can see, oh yes, it's all depreciation. So I've only got depreciation in this set of accounts. If I also had gains or losses on disposal, they would also show here. So for every line that is populated automatically from a trial balance account, it will show in the trial balance drill down. So one thing to know, so you're going to go through each of your line items that has an amount, and you're going to find out, were there any non-cash movements there? The ones that are automated are fine. You'll go and ask yourself, were there any other non-cash movements? And you'll type them into these yellow cells. You're going to type them in the direction that they impact the line item that you're looking on. So what I mean is that this is property, plant and equipment. So depreciation would have been a credit, do you agree? And so it comes in as a minus. So we know that, so that's the way, the direction that you're going to do the balance. One thing about our non-cash movements is that, going back to very basic accounting principles, I was doing some grade 8 maths with my son the other day, and we were looking at this concept of, for every debit there has to be a credit, right? So that still holds true. So for every non-cash movement, we need to make sure that we can find its friend, and that's going to be your saving grace for getting this to balance. So you're going to start with each item, and we can see, well, here's accumulated, this is the accumulated depreciation movement for the current year. Intangible assets is also a depreciation. Just trust me for the sake of time, but you can right-click Trial Balance Drill Down to see where we got that. And in total, it adds up those two to 612. That's the credit. So now for every credit, there must be a debit. What would the debit have been for accumulated depreciation or amortization? It would have been depreciation, which would have been in the income statement. So let's go see if it's there. So now we go down to the profit or loss section, and we see in the depreciation line, oh, there's the 612. So we know that both these non-cash movements have got their balancing friend. So we're happy. The same holds true. Now we've got foreign exchange. And if you do the trial balance drill down, you will see that that's the debit. And then the credit adjustment was in our trade payables and also against our cash and cash equivalents. So the cash and cash equivalents was the Forex adjustment on this foreign bank movements. So I'm happy that all of these items have got a balancing friend. Okay, if all my non-cash movements balance out, in other words, we've managed to put a debit and credit for every item, then we should land up with a balance here. But we are out by 1930. So let's go see if we can find it. So what happened is I'm like, okay, look, there we go. There's a 1929 in property, plants and equipment in transfers that we haven't got a debit for. So we're going to try and find out, okay, what was the story here? So where did Caseware get this amount? Because I didn't type it in. Transfer on property, plants and equipment. So it'll be a good idea. Let's go investigate. So we're going to go and take a look at the property, plant and equipment notes. I'm going to click in my financial statements. I'm going to just go to balance sheet, or you could remember F5, property, plant and equipment, to search for it. And I'm going to go jump on my notes, and I'm going to go to my current year reconciliation. Remember, we did this last week. And there I see, oh, look here, this is such a clever thing. It's identified that a transfer is probably a non-cash movement, all right? So it took that transfer and it put it here in my worksheet. If it was wrong and you said, for some reason you used the transfer column for some other kind of movement and it actually is a cash movement, then you can just delete it. Okay, then it will come out of here. You say, no, it actually was a cash movement, but you should try and use the correct columns in the actual recon. Okay, red dot, I've deleted it by accident. Oh dear, now that's not a good way to try and make it balance. Now you think to yourself, okay, good, now my cash flow works. It balances. No. Because this non-cash movement actually is a non-cash movement. So we're going to go override. We're just going to go find its friend. So you're going to research and you're going to ask the client, what was this for? And they're going to tell you, oh, you know what, we actually transferred that to inventory because it's a vehicle, motor vehicle dealer, and sometimes they swap between property, plants and equipment and inventory. So I guess this would have been perhaps the other way around, but just follow my logic, even if my example doesn't necessarily make sense. So that would have been inventories. Now, inventories didn't have a matching reconciliation of movement. So that's why Caseware didn't know where to put the other side. Obviously, if it was a transfer between investment property and property, plant and equipment, you would have put the transfer in and the transfer out in each of the reconciliation tables. And so it would have automatically pulled the other leg through here for you. But this is an example of a case where we couldn't know what the other leg was. So you have to go and put it in. So I'm going to now type in the 1929. And I am, if I go and take a look, I see, oh, look there, I am just about in balance. And what you've also done by consequence is you've shown that of my inventories, that amount actually wasn't a cash movement. It was just a transfer from PPE. Right, so what have we accomplished? I also just want to show you, so that, and then you're going to go through your line items one at a time. And then we're going to come here to this intangible assets, and we see something weird, like, look at that. It's showing a -1 outflow, but if I go to my intangible assets, it was first, if I remember correctly. There's definitely no additions here. And you can see now we've just got a bit of a rounding issue. So I know there's no cash movement in my intangible assets. I can see it clearly. But because of rounding, my worksheet is saying it sees a 1. So that's why you would use your yellow. It's just for the little bits where you might have a rounding issue, or like I say, there's non-cash movements that you need to deal with. So I'm going to go ahead and put the 1 in my other non-cash through profit or loss movements. And in fact, that actually fixes up the 890 was actually an 89. It just, like I said, rounded differently. See, it was actually an 89. And so now our Our intangible assets look good. So the objective of this whole worksheet is to literally find out the pure cash movement of each balance sheet line item. And so we go through them all and we just make sure we're satisfied. You can also use the annotations function to write a note, if you want to write a note to yourself to say the cash, you might want to discuss what the transfer was or what the non-cash movements were, particularly the non-cash movements that you just type in to keep yourself a trail, because somebody is going to say, why did you take that out as a non-cash movement? Okay. I further want to say that you cannot change the numbers that appear on your cash flow statement unless you type them into one of these yellow cells. That's the only way you're going to do it. Okay. So you're going to satisfy yourself here that every balance sheet line item is correct in its movement. And then we go through to the end and we see, okay, it looks right. It seems to be in balance, which just tells us, or like I said, this might still be out by 1 or 2. That should be fine for rounding as long as the final test of cash flow works. And now we're going to go and we're going to see where all of these numbers, the net cash outflows or inflows, where they land up, because now we're actually going to go and build the cash flow statement. So back to our document map, we've got the 3 areas. We've got the operating, investing, and financing activities. And then we've got our test of cash flow, which just brings it all together. So these sections are pretty much going to mirror, to an extent, what will be on the final cash flow statement, and with a little bit of workings. So I'm going to click on operating activities. And what happens here is, that our operating activities is basically taking our income statement before tax and working out the non-cash movements, and then it shows separately your items like depreciation, dividends, tax, interest, and those kind of things. And also your non or discontinued operations. Okay, so for this part of the worksheet, you'd see it's mostly white. If you just see white, it means it's just there for your interest. You can't change anything, okay? So what we've done is we've literally just taken the income statement and we've put it in here just for you to see how the items have been allocated between cash from customers or cash paid to suppliers and employees. So that's just for information purposes. And then we've got a default column, which is used later on it's just a heading for the investing and financing section. We've got reclassifications for line items, as you'll see in a moment. If you disagree with the default line it lands up in, we can move it. And then the statement of cash flows, this is the amount that's going to pull through to the cash flow statement. So obviously we don't pull the income statement part through, but we do start off, if you think in your mind, a cash flow note starts off with net profit or loss before tax. And this is our starting point, okay? So it's just showing you this 904 came from the income statement. And then it starts going and adjusting for the non-cash items. So keep your eye. We've got the depreciation, amortization, impairment. We've got foreign exchange gains or losses, just showing you where it lands up in terms of the customers or suppliers and employees. But the final adjustment, so look at the amount 612, 21,340. Where did that come from? If I go back to the worksheet and I go to the liabilities and equity section, there is my non-cash items removed from profit or loss, the 612 and the 21,340. So everything in the other sections comes from this worksheet. We'll go down further. Now I'm getting to a place where you are seeing a few yellow cells. You need not, the reason for that is if we've got, these are lease assets and lease liabilities. So for these, it could have been a lessee or a lessor. So we couldn't 100% work out where it belongs in terms of customers or suppliers and employees. So we've defaulted it to the blue. So if there was an amount in, I'm actually just going to quickly break this to show you, operating lease assets. Let's go find it. Now I'm going to battle to find it. Operating lease asset. Let's just say, I'm going to pop in an amount here. There was 1,000. If that happens, just click OK. So there was 1,000 movement in operating lease assets. If I go to operating activities, it dropped it into the default was cash received from customers. But if I say no, it actually belonged on the other side, then I would just type it in the yellow block, and it would subtract from the original what I typed in the yellow block. The logic here is that the amount that eventually shows can never be different than what is in the worksheet. Okay, but I'm just going to go and take that. Let me delete this because otherwise it's going to throw us out of balance, and go and get rid of it on top because it was a lie. Similarly, you see we've got other assets 1, 2, and 3, but we don't know what they're related to. So if you have something in the other assets in the top section, in the worksheet section, they are going to default to, sorry, I'm lying to you. That's not the right section. That's further on. There are other non-cash items. Scrap that. I was looking at the wrong place. Apologies. In your income statement, we've got all of our non-cash movements that the system can work out on non-cash movements. But then we've given you 5 other non-cash items included in profit or loss, because what if you've got other items that are non-cash, like maybe a donation received or paid, and we don't actually know what the nature is. So if you're going to put that in there, let's say so that we've got 1,000 non-cash item coming through here, it's then going to work, and just to keep it in balance, I'm going to put minus 1,000 on that part, okay? Oopsie. Clicking in the wrong place. Go back to operating activities. So you're with me. I've taken other non-cash items out of my income statement section, which are somewhere in my trial balance. So in other words, they're included in my net profit amount of that I've got here. But the case we didn't identify them specifically as non-cash movement because they were not the common non-cash movement. So I've typed them in here. If I go to operating activities, it's going to bring them out as non-cash movements. And I've just got the ability to put it in a different column if I disagree. So I'm going to put them there, and the total remains 1,000 and minus 1,000. No matter what I do, I can't change the fact that it'll be 1,000. It will just use the maths basically to reallocate in such a way that the total movement will always be 1,000 that you actually see on the cash flow statement. So that's just a fail check to make sure that once you've worked out the cash movement in the main worksheet, you can't actually go and break it later on. Okay, so I've done mine an equal and opposite so that I don't have to go and take it out again. But obviously these are not here. Then it takes the items which are presented separately. So it takes out our interest, our investment income, our finance charges, and our movements in working capital, which are changes in inventory, receivables, and payables in this case. And all of them came from that worksheet. I'll just show you 1 or 2. There's the movement in receivables, the 19, and the 12 movement in inventories. So if I just jump back to operating and I go to the working capital movements, there they are. The 12 in inventories and the 19 in trade receivables. So this will all pull through to the cash flow statement. And so this part you can see is the same as you're used to seeing. Then we get our cash generated from operations, and we then bring back those items, the interest, dividends, finance, cost, taxation, and so forth. You'll notice that these are lying in a default other column. So what this means is we're defaulting all of these to operating activities. But you might say, no, I don't want interest income in operating activities. I want it in investing activities. So how you're going to do that is you will just go find the interest income line in investing activities. So here's investing activities. So let's go down with that 775. There it is. And I'm going to put that same 775 in the reclassification line item. So I'm saying I want the 775 to be here in investing activities. And you'll see it will automatically take it out of the operating activities so that there will not be an amount in operating activities. And that's a process you'll follow to move your dividends and your dividends received and your finance costs as well. Okay, so that's the operating activities. Then the next step is our investing activities. So everything that was in the cash flow worksheet, which is an investing type asset, would land up in this section. So we've created all the different line items So if we look at property, plant and equipment, you see we've got purchases of property, plant and equipment and proceeds from sale. Then we've got investment property purchases and proceeds. And so you go through the various line items with its corresponding alternative. So we've got cash advanced in loans from group companies, but then we've got cash repayments on loans from group companies. So what we know is that for property, plant and equipment, the only movement that is tolerated in the cash flow statement is a net movement of 68. Why? Because if we go back to our worksheet and we go to the property, plant and equipment line, we calculated that the cash movement was 68 outflow. Okay, so that it has to be that. But we defaulted to a line which we felt is the most likely movement of that cash item. It might be that we've got the wrong line because obviously how many entities are using this. So if it's not the correct line, that's where you're going to use the yellow cell in the corresponding line to just reclassify it and say, no, it wasn't purchases, it was proceeds. This is a bad example because this one actually calculates both. I'll show you what I mean. If I were to put that minus 68 there, it's going to give me a red dot telling me that it is calculated. So for our PPE, our investment property, our biological assets, items which have got a reconciliation table, we've got a calculation which actually calculates the proceeds from sale. So it takes if you go into the note, it will take your disposals and it will take your profit or loss on disposal and it will work it into here to give you a proceed. Okay. But that's how you reallocate. You use the corresponding line. Then what we would also do, I'm going to show you the next one is, so every line item here pulls through to its corresponding section. Intangible assets had a zero cash flow, so there's nothing there. Trade and other receivables was in working capital. Inventories went to working capital. Retained income is, remember, the net profit movement. All of these non-cash movements we saw in the operating section. The interest, dividends, and tax was in the operating section. So all we're left with is loans from group companies and trade and other payables. And these are both trade and other payables, obviously in our working capital. So we've got just this in our financing activities, an inflow of 10,258 of loans from group companies. So that'll be in our financing. So if we go to financing activities, we see that movement in the loans from group companies, and it's defaulted to the repayments line. And you can actually see logically, well, a 10,000 inflow can't be a repayment. That should have been in the advance line. Of course, we couldn't know upfront what it was going to be. So this is where you'll just say, no, this is step one of the alternatives. You'll say, no, that 10,258 actually was a cash advance. All right. However, it's very likely, remember, this is just a net movement, this 10,258. Most likely you got a big advance and then you started paying some back so that the net amount was 10, but that wasn't the actual movement. So if you know that, let's say you actually got a 15,000 cash advance from the group and you enter that, it's going to adjust it as a negative against the net 10,000 movement to show you what actually happened. So now it tells you, you got to 15,000 in, but you repaid 4,742. So at the end of the day, you cannot move away. The two together is still the 10,258, which you calculated in the cash flow worksheet as being the true cash movement for group company loans. Okay. Obviously, if there were transfers between I'm trying to think that you would obviously have taken out the non-cash movements in your group company loans. Like you might have had loans from between directors and group companies or however. I'm trying to make up random scenarios here. But in your worksheet, you will still remember to our 10,258, where are you? There it is. And you would take out any non-cash movements here and whatever the other side is as well. So you could have had loans two group companies on the asset side, and you could make movements between them just to get your final cash movements in the right line. But the overall true cash will reflect in the final column. Okay, that's your financing activities. Then we have our test of cash flow. This is the one that absolutely has to be 0, because obviously a cash flow is not in balance unless this is 0. This is taking our movement for the year, is obviously taking the 3 sections and adding them up. And then it's giving our cash and cash equivalents at the beginning of the year, any foreign exchange on that cash, and then our closing balance. So again, if you see a 1, it's quite obviously to do with rounding. And so what I like to do on that final place is I would just go to, where did I do my rounding? Remember when we rounded last week or the week before? It just goes so quick. We rounded to trade and other payables. So I'm just going to put that rounding effect here. And I think it's a -1. I might have it the wrong way. Yes, that was correct. So just to make sure it gets all in balance, all that we did is we just took the rounding to trade payables again. Trade payables, the 1. So it just adjusted the movement here by 1. That would have pulled through to operating activities because our rounding movements have always gone to trade and other payables. And then it's going to balance. What you're going to find now is if we go to our financial statements and we go to our cash flow, everything has now pulled through. There's our finance cost. It's literally pulled through. There's our 68 purchase of PPE. There's our interest income, which we moved to finance investing activities. There's our split in group loans, and then our cash section, which now balances. If we go to the note, cash used in operations is our note. It's got an N hash, which means the note's not on. So you can't jump to it directly by clicking on the number. So you're going to right click and jump to note. And then you're going to stand on the note and just right click and turn it on. And now all of these movements, you'll recognize, and do you remember the 1,000 and the -1,000 that I put into the worksheet just to show you how it works? They pull through here. So these are our other non-cash movements. I'll just type in what they must be here. So if you feel that there's different non-cash movements than the categories provided, you're going to type them in here. Obviously, they must already be included in the net profit amount. There's all our movements in our working capital. And you're going to capture, just for the first year, the prior column. Okay. Hopefully you followed that. There is a cash flow statement video. Please look at that in the e-learning. It takes through in quite a lot of detail and obviously a bit slower. I just don't want to steal too much of Ninka's time. Last thing I want to show you is this is the indirect method. I always confuse myself. Let us change to the other method. I think this is a direct and we want to try and move to the indirect. So we're going to stand up in gray bar or somewhere in the cash flow statement, and you're going to click on the little cog and you're going to open it up. And yes, so we're currently on the direct cash flow. So if you want to show the indirect cash flow, just click indirect and okay. And it changes the layout for you so that now you're starting off with your profit before tax and then you're showing all your adjustments, and so it goes on. All right, hopefully that is made sense to everybody. I hope it wasn't too quick. Maybe it was too slow. But yes, I'm just going to hand back to Ninka and enjoy the rest of the session.
Thanks, Angela. I see there's no more questions about the cash flow, and we've got a hand clap, so thank you for that. We're going to take a break now let's make it for 10 minutes, so 10:05, so you can get your coffee and just a bit of fresh air, whatever urgent message you have to send. So we will start 10:05. Okay, guys, let's start with iXBRL. So you have two terms. You've got iXBRL and iXBRL, and I will go through the details of which each of them are. But firstly, so if I use them interchangeably, I'll show you what the difference are. What iXBRL is, it is a global framework. So it's something that the ISAB also maintains, but it's also used for non-financial data. And the idea is that you have one format of iXBRL that's then used globally. And what that does, it makes data more comparable. Now, think about your mapping structure in Caseware. So similar to that is something that's called a taxonomy. So you'll have revenue lines and you'll have your expenses lines, you'll have assets and liabilities. Now, in South Africa, we use the iXBRL for SIPSI. So when you have to submit your annual financials, certain clients have to submit it in iXBRL format. Now, we in Caseware have it in our products already embedded. So it is in your IFRS template, it is in your SME template, it's also in your GRAB template. And as it becomes mandated, and we do have one of those, we will also make it available. But let's just get a bit more of the two definitions. So iXBRL is a freely available, like I said, it's a global framework, and it's to exchange business information. The iXBRL is all about function, while iXBRL takes that function and puts it in a format that is more accessible and visually appealing for the user. So iXBRL is, let me show you, it's going to be the easiest to show it to you. So I've got 3 files here open, and we're going to get now into the file on how to do it. So this is a file that and how your iXBRL file will look when you submit it. So it will look like this. It doesn't really have, and this is the one that you can see how it will look. Then you have this one, which if you hover over it, it will show you your taxonomy. And this is the one that we use to review. And I'll show you also where to get that one. But this is actually how the file looks when SIPSI receive it. So you'll see it is not readable. So it's exactly the same file, just in different formats. So if we talk about iXBRL and iXBRL, it is exactly the same file. It's just the 2 ways. Why iXBRL has it, or why SIPSI use it, is if I get it in this format, it's much easier for them to analyze. If I get it in previously in a PDF format, it meant like human intervention that had to review each and every line. This they can put into their processes, and they can very quickly run checks on it to make sure there's compliance. They can make sure your PI score is calculated corrected. So it gives them a format for them that they can easily consume. So if we then jump just back a bit to, so that's the main difference between iXBRL and iXBRL, if somebody asks you. So who needs to do iXBRL? So in South Africa, you have to do iXBRL if your PI score is more than 350 for any reporting period, or if you ask for internally compiled at least 100. And then there's some enterprises, your LTDs and your SSCs, they must always do it. And then there's some other business activities and business function. But the most important thing is the PI score of 350 or internally compiled 100. And then the last one, your MOI. So if you still have an MOI that says that you must be audited, then you also have to submit iXBRL financials. Now, that is the one where you sometimes get almost a dormant set, but because the MOI hasn't updated, they still need to submit iXBRL. But if you look at the PI score, the intention is really for your bigger entities to have to submit it. When iXBRL was issued, it was or mandated by SIPSI. The 350 was set as the PI score at that stage. There is discussions from SAICA side and also from SIPSI side to increase that number, just because obviously with inflation and all the values increased, but that must be a different number, not 350 anymore, either 500 or 700 or 750, but that is something that is still in discussion. Currently, it is still 350. So when I talk about taxonomies, we have the IFRS accounting taxonomy that gets issued by the IFRS board. So if there's a new standard that comes out, like now we have IFRS 18 that comes out, they will update the taxonomy for the new IFRS 18 content. Then SIPSI adds mandatory elements to that taxonomy. So they take the IFRS accounting taxonomy, they add their elements, and that then becomes the South African taxonomy. Now, the SIPSI mandatory elements is not something that's always available in your financials. Some of it is very specific questions, but some of it is like your customer number or something like that. So it's not necessarily in your financials, and therefore you have to add it. Then we also get purely the IFRS accounting taxonomy with no changes, And this is a requirement that we're seeing more in Africa coming out, but they actually use it as this. But this is really used worldwide, so any country can use it. But what they do there is they just take the IFRS taxonomy, and then they say you have to submit under iXBRL or iXBRL. Now, the two regions that we currently see that is using it like that is Mauritius and then also Nigeria. They do have some regulatory requirements to submit, but it's the pure IFRS accounting taxonomy. Now, the ideal in South Africa and worldwide is, like I say, you have one taxonomy, and then if everybody submits under that, then you only really have to submit once. I mean, that's the vision. And then your SARS or your Reserve Bank or your JC can all pull information from that one submission. Currently, it's only SIPC that is using the iXBRL format. And the reason for that is the definitions from a tax perspective or the accounting perspective, and then from a how they report on is not exactly the same. So they currently can't align the taxonomies for the users to have that benefit. But it is something that they are hoping to work towards as a government. Right, so let me go into a file. You're welcome to follow. If you do have a file open, you're also welcome to play around with it, but it is going to be a bit more of a demo, but you're welcome to click around on it. So I've got an IFRS file open here, and then what you will see is you'll have an iXBRL button here at the top. Now, this will be, if you select in your information store, South Africa, all your files will have that iXBRL button. If you select any other region in South Africa, you won't have that button, except in IFRS, and I'm going to tell you now why, in a bit why. But you will see that button once you select your region as South Africa. As soon as you select this button, you have this banner that comes up with all these, with this toolbar here, and your managed page gets included. Now, it's very important that the intention from SIPC side is that your financials should look exactly like your iXBRL file. The intention is that it should have the same, no, let me rephrase that. It should contain the same information. It doesn't necessarily need to look the same. If I say the same information, it is your full set of signed financials that needs to be included. But because they get it in that machine readable form that I showed you, they're not going to mind if there's a bold or an underline or something that's not the same from a formatting perspective, but the content should be exactly the same. So how this then works is you have the managing page switch on. Now, I've already completed this, and some of the information will pull from your information store. For example, your date at your end of reporting period, we can already pull that in. So some of it will be completed and some of it won't. And some of it you have to go to files, fill in a date, open your PI score, and you'll go through this and complete it. And then you'll see at the top is two, these radio buttons here. And then let me show you this one, which is saying to you that there's a mandatory field which is not completed. Now you'll see as long as you have these indicators, you cannot validate and export. So as soon as I select this, so it says the professional designation of the person who prepared this, and I'm just going to choose the first one, then you'll see completed all my mandatory fields. So that one section is now complete. And I'll continue to go down and to answer the questions. And then at the bottom, there is some financial statement items that are also mandated. Now, where we could, we'll pull the information through. And so this list can look completely different. If you say, for example, I can't remember now offhand the other one, but if you had other areas here that you had to show and it's not in your financials and it's tagged, then it would still come up here. So this list changes depending on how your financials look. But the one area that, like administrative expenses, we don't have a specific line for it. It's on your income statement. You can type it in and then it adds and deduct it. So for that reason, we've also added here. So it says you have to have your admin expenses. So either you type in your figure there, or if it is null, you have to provide what they call a footnote. So if I click on that, it will open up a footnote and you can say the reason why it is null. No admin expenses. And you can save it. And as soon as I do that, you will see that my radio buttons, if I just scroll to the top, is now gone and I can validate and export. Now, there's a few rules that we've built into the product, and the reason for that is it can sometimes be disconnected to your whole financial statement preparation process. Your financial statements, obviously, so say you have a December year end, you have 6 months normally to finalize it if you listed 4 months. But your SIPSI submission of your iXBRL file is not dependent on your year-end date. It is dependent on your registration date of that company. So if a company was registered in October, it means that you'll only submit your iXBRL document in October. And normally it is also your secretary that will do it and not necessarily your CFO or your financial person involved. So we've tried to add a few validation processes, the one being this button that grays out, to assist our clients that while you're busy doing it as the preparer of the financials, that you will most likely not have errors or issues when it comes to submission, because there might be a time delay in when that happens. So the first one that we did is this validation and export. So this is now showing, and then if I jump to the balance sheet, I'm going to say I want to review my tags. So we pre-tag everything that's in your financials in our template. So you don't have to go and tag it, but you can review it. And you also might have line items that you've added. You've maybe used your other assets for something very specifically. So you can go and you can review your tags. Now, the whole iXBRL does take up, it is linked to the internet. So depending on your internet speed and all of that, it is a little bit of a slower process, but just let it run because it is dependent on your internet speed. Right, so you'll see as soon as I click on review tags, and then you can see these tags. And then if I hover over it, similar to that screen that I showed you, you can see which each of those tags are. And it also takes out all the information that was not going to print. So if I go to view, you'll see my enable editing switches off automatically, just so it makes it easier for you to see what is going on. So if I go to my balance sheet, then you'll see here is my tags. Now, say for example, I've used my trade and other receivables for something else. I didn't use it for trade and other receivables, so I want to go and change that tag. You can just go on edit, and then it will open the taxonomy for you. So this is, as I referred to, similar to a mapping structure to say it needs to be something else. And then you can basically just click on it and you can say, okay, and that one will change. Similar to something that wasn't tagged, you can just go in here and tag it. So I'm not going to change this one now, so I'm just going to cancel. But that is how you can go through and tag. Most of your files, however, like I say, pre-tagged, so you wouldn't have to spend a lot of time in the review. You can just make sure by the colors, if you quickly have a look, that everything in your financials are tagged, and then you can validate and export. Now, there is here a report. If you click on that, you have this HTML report of acts, including a review of tag data. So that's the one that I showed you. If I just go back here, this one, that if you hover over it, that you can see what the tags are. So you can export this and send it to, if you're preparing on behalf of a client and they want to look at the tags, you can actually email this to them. Because if you email the actual iXBRL document, which is this one, they're not going to see the tags. And if you email this one, they're not going to really understand it. So this one is the interface that shows you, just to make it easy to review for somebody that's maybe not in the file. Right, so that is the iXBRL file. Let me just quickly have a look. Then we have, so if you then validate and export, I'm not going to run that process now. What it does is it goes through a few validation steps. The first one is a caseware validation, so it's in the product, that it will show you, like if you have maybe duplicate tags or something like that, then those will come up and you can fix it before you send it out. After it's gone through that process, it does another validation. And that one is quite a it's the same SIPSI portal when you submit the financials. We have that portal that we test this file against to make sure that there's no errors. So it's a duplicate of the portal that you submit your iXBRL file on from SIPSI that we do the testing on. And that then will bring up a screen with some areas that you need to go fix. So those validation things we've built in. So like I say, if you then give it to somebody to submit, it's already gone through those validations and most of it should be eliminated and you wouldn't have issues to submit it. Right, and then there is, and why I've now got an IFRS file. If you've got an SME file, you won't have this drop-down box. But if I select that, you'll see the IFRS accounting taxonomy. Now, the IFRS accounting taxonomy is the one that I showed you that some of the other regions in Africa is also starting to use. So we've made it available for everybody. So meaning if you select South Africa, it will default to SIPSI and it will have the SIPSI taxonomy. But if for any reason you want to use the IFRS taxonomy, maybe it's part of a global group and they want to submit it for the group company, you can also use the IFRS accounting taxonomy as well. And if you then select any other entity, any other region in South Africa, you will go the opposite way. You will default to the IFRS accounting taxonomy. The difference in the IFRS accounting taxonomy is you won't have the mandatory information page because there is no mandatory page, if you remember the slide that I had. And because we can't validate that with the different regions, we don't have the validate and export, it will just be an export functionality. So there is a little bit of a difference, and then obviously your taxonomy is different. So there is a little bit of difference, but it does mean that you can submit that successfully to those different regions. Right, then we do have also two other products, which I'm not going to show today, which is called iXBRL Lite, which some of you might come across or have come across. And what that is we have an iXBRL Lite SME and we have an iXBRL Lite for IFRS. And what that is if you don't draft financials in Caseware, you get a PDF set and your client, maybe it's a new client, the previous company has drafted for them. Now you're going to do it in Caseware for them. But because of this time delay of what I explained on when you need to submit and when your year end is, there might be the possibility that you need to actually submit PDF financials or convert PDF financials to iXBRL. So what the iXBRL Lite is, it's a capture sheet. So it's basically, it looks the same as case view, but you capture the images in the different blocks for the taxonomy. So it is important to note that it is available. The rest of the functionality does work the same, but the idea is that you, or the huge benefit is if you can use it in the product, then you have one process for your financials and your iXBRL, where the iXBRL Lite is more if you're in the situation of you getting a set of financials which isn't prepared in Caseware and you need to submit that. Let me just double check if there's anything else on iXBRL. There is not anything on iXBRL. There is just one thing that I want to show while I've got the IFRS file open. I'm just going to quickly open the information store. And this is large enterprises. Now, we have in the past, it's always been something that's available in the IFRS template, and it has to do if you have a listed entity. But we also have some entities that would like to disclose this information, even if they're not a listed entity, like, for example, your earnings per share and those kind of information. So it is available in your IFRS template. And I just want to show you where it is, because it is something that we also get asked quite a bit. And it is very easy to activate. So you've got here this your information store, large enterprises, and a tick box here. And then what it includes is, like I say, your earnings per share. Let me quickly get that file open again. So if I just go enable editing, then I can see all my notes. It's got, for example, this earnings per share note. It's got the note that is additional that switches on. You've got your segment reporting. You've got a few more reports that switches on. So if you do have a large enterprise entity that would like some of that disclosure, just take note that it is available in your large enterprises. Right, with that, I'm going to close this file and then we're going to go into the consolidation. And I'm going to start a brand new file for that you can follow with me and do it with me as we continue. There is one slide while that closes that I would just like to share on iXBRL. So there is one of the biggest support calls that we get for iXBRL is the file hangs, if you want to call it. It looks like it doesn't finish when you validate and export. Now, there is some security that you have to set on your folders for that file to actually write to your caseware folder, some permissions, and that is quite important. So what I'll do in our break, I'll just put the link for this on the chat. So if you have ever an issue with it, you validate and export, but it seems like it doesn't want to finish, then double check that your access right on your caseware folders are correct, because that will most of the time solve that issue for you. It is also important to note for the update process is iXBRL update runs separately from the financial statements. And the reason for that is because the taxonomy gets updated normally in October, and we wanted to be able to update files without affecting anything in your financials, again, because of the time delays between submission and year-end date. So if you download a template, any of the latest template, and if you remember the first session that you have the option to update your working papers, and you have the option to update your financial statements. Your financial statements, we always recommend you don't update when you are in progress. But if you open that financials for the first time, even if you don't update your financial statements, your taxonomy and your mandatory page will update. So it will take a little bit longer to open. It will give you a box to say it's updating the iXBRL. So the only thing that it updates is the taxonomy and the mandatory page, nothing else in your financials. Right, so with that, let's jump to consolidations. So what is a consolidation? So a consolidation is that a company must prepare because there is control. So that is very, very important. So it's a group set of financials that you have subsidiaries in normally, and you have to prepare that set of financials. Now, if you are a first year, you might not come across it a lot. It might be something that's a bit more advanced, but this is one of the things that the team has asked us, or the surveys came up and has asked us to cover as well. So we are going to go through it, but if you are starting a console later, there is also additional training. You can refer back to this video if you want to, because it is something that you might not use immediately if you are a first year. So if I look at our console today, I thought in the spirit of our car theme this year, I'm going to do Formula One. I am a bit of a Formula One fan. And I first thought I'll do the whole Toto Wolff, Christian Horner, which is bidding for the 24% on the Alpine team. But I thought that might be a bit complex for today. So we're going to do a very simple console structure. And the one that we're going to look at is Formula One. And Formula One holding company has 3 subsidiaries, which is Formula One, Formula 2, and Formula 3. So the only thing that's real in this scenario is the group structure. The figures and the TVs are definitely not. So that is our group that we are going to work with today. So 1 holding company and 3 subsidiaries. So with that, and we're not going to refill now. Sorry about that. We are going to start a new file. So if I go to my caseware working papers and I select new, and we're going to do this on SME as well, just because most of you have it. If you don't have SME, you can use any other template. And I'm going to say this is my Formula One group set for 2026. I want to save this in my Get Ahead folder to make sure I have it all together. And I see I already have a Formula One group, so I'm just going to say holdings so I don't get confused. And you can then create your file. This process you've already done with Angela. It is exactly the same, and you can create your file. Remember, if you haven't downloaded the Excel, you can also download that. We're going to use those TVs to import shortly. So you can just make sure that you have that as well ready in the meantime. I'm quickly going to stop sharing my screen. I just want to switch something around, but I'm not going anywhere. I'm still here. Let me just switch my screens. Right. So if you are doing it with me, then if you get to this screen, you can again just go issue P, and you can click on OK for your file to be done and being created. The new file wizard, again, you can just select preparation and you can continue with that as well. Right, and then if you get to this screen, your engagement properties, please change your year-end date here to 31st December. 31st December. And if you want to, you can also change your name here. I want to say this is my F1 group and holding company Pty Limited. You can make up your own name, or you can just say Consolidation, or you can just leave it as it is. But important that your year-end date is 31st December 2025, because I am going to show you something a bit later, but it's quite important that that date is correct. Okay, and you can select on OK. So up until this point, nothing different to what Angela has showed you before. Then what you can do is, if you go into engagement, you'll see this button Consolidate there. And that is where you will set up your structure. And it's quite important, a few things that you do on the screen. Now you'll see here that you have the top level. One of the important things here to do is to not have anything in that top level in regard to a specific entity, meaning a subsidiary or your holding company, associate, JV, whatever the case might be. And you'll see now when we go into the financials, into your column settings, why that is very important. So you'll never import a TB on that level. You might have some accounts for your journals, but no TB in there. So if I go back to our group structure, I'm just going to quickly bring it back up. Let me maybe paste it for us in the chat as well. if you want to refer to it again. And then, so we have a holding company, and then we have F1, F2, F3. So we are now going to create the structure here. So I'm first going to say, right, my first company that I want to create is my Formula One holding company. And you'll see it will automatically change the abbreviation to FHC. You can change that if you want to. But for this file, also please don't change that because we're going to import some journals, and then it's important that this entity abbreviation is the same. So, but you can change that to whatever you want to be. Then you have different options here, and this is quite important to understand what they do, because that's going to determine if your engagement setup is correct or not. So you firstly have two options. You have none and existing file. So we're going to be doing all ours on none today, which means I'm going to import my XLTB. But if I already have done my 3 subsidiaries, F1, F2, F3, I could also link those files. And then I would have clicked existing file and I would have browsed for it and I would have linked it. We're not going to do that today, but it is important that I explain how this functionality works. So if I click on existing file browse, then you'll be able to tick all these boxes here or not click it. Now, some of them are quite self-explanatory, like your budget and your forecast. I'm not going to go into detail of that, but there is two that's very important. And one is your prior balances and the enable account synchronization. So if I do my file for the first time. So like a console that we're going to do today is a console that was done before, but it's the first year that it's our client. So meaning I have to set up and pass my journals for current year and prior. Then you will click that box because you want from your file of your subsidiary 1, 2, and 3, the prior year TB and the current year TB to pull in. So then you will tick that box. But if you now roll forward this file, you do not want your prior year to be overwritten because you've already consolidated your prior year figures. So if I roll it forward and I link that again, what's going to happen is it's going to import my figures from my subsidiaries and my eliminating journals will not be in there anymore. So it's very important if you do a roll forward of a console file to never select that include prior balances. If you do, then it means you'll have to pass your prior year console journals again. So we get this quite a bit, that the client's expectation is not, or that you don't do it quickly and you rush and then you forget to untick that in your second year. And then you'll have to go and redo all your journals. So that can be quite time consuming. If you do it, then it might be easier just to do the roll forward again and just quickly do it again if you have a lot of journals. If you don't have a lot of journals, then it might be quick just to pass them again. But that is very important depending if it's your first console that you're doing or if it was done before. The other one is this enable account synchronization. So what this does is if you have your grouping from your subsidiary files basically get pulled into your console file as well. So again, if you do it the first year, you definitely don't want to remap everything that was in your subsidiary file in your console file. So you're definitely going to keep that one ticked because you wanted to pull in the mapping with your TB and your journals and everything else. But again, if it is a roll forward file, if you do a console in your first year, you might remap certain things from a subsidiary. Now, one of the examples that I can think of is if you, for example, have other receivables, and in your different subsidiaries, some have mapped other receivables to other receivable 1, and some of them have mapped it to other receivable 2. So now if you come on console, those 2 lines won't be one line on your note, it will be 2 separate lines, which is wrong because it's actually both other receivable. So what you will do then is you will actually map them together so that it is one line on your console file. Now, ideally, if you can, go back to your subsidiary file, or when you do your subsidiary files, make sure that there's consistency. But you can't always do that because of timing and how all these things work. And then what you would want to do is you wouldn't want to synchronize your account synchronization in the second year because it's going to change your mapping back to what your subsidiary file is. So if you tick that, it means it's going to keep your console for prior, if you untick it, your prior numbers, the mapping is not going to change for it. Your console is going to be exactly the same. But the downside of that is if you have a subsidiary with a lot of new accounts, then those new accounts will not be mapped. So this is not a tick box that you always tick it or never tick it. The one about include prior balances are, this one is not. This one you have to think what is going to be the most efficient for you to do. So I once did a client, it changed accounting systems and there was around 3,000 accounts. Now there's no way I'm going to map 3,000 accounts in 2 files. So then I would do enable account synchronization and I will just remap it rather on a console level because that was a lot less to do to make sure my notes align than it was actually to do in the file. So it does depend on your circumstances. Right, so those are the things that are very important when you do it. So let's go ahead. I'm going to do the rest of my group. So the first one is your F1 holding company, FHC, and it's selected on none. And you open that console structure again, there will be a yellow indicator there. It looks like a little broken file that shows you that there's actually been changes made in your subsidiary file that is not in your console file yet. And you can go and just relink it again and it will sync up. So it means you don't have to pass your journals on both your files. So it is ideal to really, if you do the files, sync it up, link it is the best way to do it. But for practical reasons, we're just doing the Excel files today because we are a little bit time constraint and we won't get through everything if we do link the files as well. Right, I just want to double check. So then if I go here, you'll see this is now changed. So now you've got your group here and there's your group structure and you've got your year in there. I'm going to import the TBs. Let's start with that. Let me just quickly get my TB. It's history. Yeah, so this is the TB that I've given you guys. And if you go to the first tab, you'll see that this is a TB. So like I say, not a very big TB. And I've got my current year, my prior year, and I've color coded it just so that it looks nice and easy to follow. So I've got my F1 holding, F1, F2, F3 for current year, and I've got the same for my prior year. So now let's import the TB. I'm going to move back to the different slide. And this is exactly the same like you've done with Angela. You go import Excel file, make sure that it's there on chart of accounts. I'm going to browse for it and I'm going to select that and I'm going to be on sheet 1. I'm going to go a bit slower on the first one just to show you and then you can do the rest. So yeah, I'm going to untick the first 2 rows because those I don't want to import. Those 2 I don't want. The last 2 I don't want. And then I'm going to go next. And then I'm going to start labeling it. So I can say, okay, account details, account number, account details, account description, grouping, mapping number. I'm just going to pause there for a second. So you've got account number, account description, mapping number. And then I've got here, I've got my balances, my current year balance. So this is exactly the same. We'll select your entity now, so don't worry about that. Prior balance, and I'm going to say opening, and I'm going to say next. And then this is now new to what you've seen before. So you can have, but you assign it here to the different entities, but I have it in different columns, so I'm just going to import it like that. So as soon as you say next, then I'm going to say, okay, this is my holding company. Again, not the top one. And I'm going to say, okay, I'm going to have this screen again, and I'm going to say next, next. And then I want to show you this. I think it's something that we haven't shown you before. So this is a layout file option. So what you can do here is I'm going to say my F1 group. You can just name it. And then you can browse. I'm just going to put it on my desktop. And I'm going to save it. And I'm going to import. So if I have a few TBs, and it's not only in a console that you can use that functionality, it's also if you do a few entities that are the same or the same structure, then you can use that format. And then what it will do is, I'll show you now, is when you do your second one, it will already have your columns for you. So that can save you a bit of time if you're doing a lot of files or if your TBs are always in the same format. So if I now go again, import Excel file, then you'll see here is my record layout file is already selected. So that was the one that I just saved. So I'm just going to go say next. And again, I'm just going to untick my accounts like that. I'm going to go next. And then you'll see it will already have account number, account description, mapping number is already included there. So I don't have to go and redo that. But my current opening balance is now this one. I don't want that one, so I'm going to say ignore. I want now this one. And I'm just going to do it like that, ignore, and my prior balance. And I'm going to import. And that is then for F1. Same process, next, next. I can resave it, but at this point I don't want to. I'm just going to use the same one, but you can. And I'm just going to import it. So go ahead and just import the other two as well, the F2 and F3. And then if you're done with that, then you can just wait for me to also get there. Right. If you are done, just give me like a thumbs up. I can see if some of you are at least following and are done. Otherwise, I'll just give it a bit more time. Thank you. Got some thumbs up. Let's give it another minute or two. Right, so I'm going to go on. I'm going to show you a few reports. So if you're still busy importing, you're welcome to go on. You don't have to do anything. You can just watch if you're done. So if I go under my trial balance and journal entries, and if I go into my trial balance, I normally use my trial balance by lead schedule. So let's open that up. but I don't like this format very much. Let me just go to Tools, Options. And if I go to Documents, if you don't want to see your zero balances, then remember you can just untick it here. So if you go Tools, so let's quickly, Tools, Option, Documents, you can untick that and then you won't see your zero balances, which makes it just a bit easier for me. So if I go to my trial balance by leads, looks like that now, but I do want to see a bit more detail. So let me go right click, properties, and I like account balance with, let's do with split up. Right, so now I can see all my accounts. And if I go to my TV by map number, I can see it like that. So here you'll see, so like there's the F1 holding company, and then you'll have FHC, which is my top one, and there's F1, F2, F3. So that little entity abbreviations is the ones that pull through there. If I ever want to maybe see just F2, I can select F2 in the dropdown, and it will change and it will just show me the F2 TB. Now, if I have journals that I need to pass, say I've linked this file, you'll still see the normal journals in here. So I've processed tax on F2, then that will come through on this column, but you won't be able to change it on this column. That you'll have to do on the file. But say I didn't do the file, like in our case, and I want to go process a journal, I can do that just in F2's books by processing a normal journal. So that is our normal TB. Then I have another one here, the console worksheet summary. If I open it, it looks like that. I also like to change it a bit. So I'm going to make a copy. You can just Control-C, Control-V if you would like to. And I'm going to go properties, and I'm going to again say account balances of group subtitles. I quite like that view. And if I open it, then I can see my stack up. So 0, remember, was the console at the top. So there's nothing in that TB now. Then I have my holding company, F1, F2, F3, my total. And then this is my eliminating entries. So if I've passed my tax journal in F2, this balance here will be after the journals. So any of these figures are your final figures after journals that pull through to the console worksheet. And this consolidated figure is then the one that will be on your Fs. Let me just double check if there's anything else on this. No, there's not. So what I would like us to do is I would like you to open your financials. It is going to take a little bit of time to run. It's not a huge TB, but it is. So I think let's take our 10-minute break again, just so that you can open your financials, that you can make sure your optimizer comes up, you select next, because then when we come back, we're going to look at the journals and your setup on your financial self. So if you can please start your financials, optimize, and then around 5 past, we can start again with the console. Okay, welcome back. I'm sure your file would be done by now. So let's have a look at that. So if you open your file, it will still look like a normal file, nothing different. And you need to set up or need to make the selection that it's a group option. So if you go into options here, you have group figures there, which you can switch on. And then as soon as you do that, you'll have your 4 columns that switches on for SME. In IFRS, you have even the option to switch on 6 columns if you would want to. If you don't have, if I go to options, group figures, if you don't have that option available, that is the one that I said you might need the code for. So if you do have a code and you go to your firm settings, so document 10.10.02, you might just need to update open the folder. Then there's different activate, deactivate codes you can put in here. It opens up on the one that says group options. Mine is now already activated. You can just say activate and you can put in the code there, and then you'll have the group option available. So if I jump back to my financials, you will see, if I jump to my balance sheet, it's easier to see. You'll see currently that my group and my company figures looks exactly the same, which is very, very unlikely, if not impossible. So what you need to do is, if you now go to options and you go to column settings, then you'll have this that opens up at the top. That's group and company. And then there's a drop down at the top where you can select your entity. So if you select there, then you have your holding company, which you're going to select on this side, because that's my holding company figures that I want. And on this side, I want the top one, which is the 01. And you'll see if I do that, let me just scroll down a little bit because those balances are just, if I look, for example, at my cash, sorry, I just want to go there to know. And I just want to double check there. I have done something wrong because it is exactly the same. Let me just refresh that. That goes to F1. And let me make that F1. Then you'll see it will change. I potentially did this in the wrong TB. I pulled my TB in the wrong line. But that is how you'll change your group and company figures. It is, and this is why the group structure is so important, because if you have imported your TB on the top level, you won't be able to change it here on the side. So I'm just quickly going to go to my trial balance. And I just want to see. Doesn't look like I've done it. It's probably just a refresh one. Why it is not working. But let's continue. It should update now in a second. Okay. So that is how you will do your settings in your financials. If I then come back here, a big part of the financials is also, or for your group set of financials, is also your consolidation journals that you need to process. So if you open your Excel sheet, and I'm just quickly going to drag it over here. You will see in the second tab, I have the TBs at the top. It's just for reference. You don't have to do anything with it. And then you have your journals here at the bottom. Now, if we just process like 1 or 2, I just want you to get the feel for it. So I'm going to do the first one, and then we can maybe do the last one. Then just so that you can see what the difference is between a normal journal and the journals that's now eliminating. So if I go to my first one and I want to say new, and I want to put in here my description, and I'm just going to say at acquisition or whatever it can be. And I want to change it to be an eliminating entry. Now remember, eliminating means it's just going to affect my consolidation figures. So I don't want this to be on holding company level. All of this needs to be on elimination level. And then this field here is a new field that you have, that is group and holding company. So if I click on that, you'll see it's got holding company, F1, F2, F3. So it's my group structure again. So I want to process the first one. So that means if I look at my journals on my Excel sheet, it's got the first portion is in F1. There's some share capital there. So if I click on F1, And then you can either use the drop down, and in your console, you'll always eliminate 100% of your share capital at the end. So you can quickly check the number here as well, or the journal. You can double click on it, and I can say, right, that is my debit for 500. Now, the other part of my elimination journal is in my holding company, which is the investment that I have in the subsidiary. So if I go there and I go to case 2 journal and I go to -4, then that is the other side of my entry. So for this one, I also had some goodwill because you see I paid 4 million, probably gazillion dollars for it, and the share capital is only 500. So I have some goodwill. Now, I don't have a goodwill account in my TB yet. Now, you can make the choice. It doesn't matter on which level you create that new account, but it is just important to try and be consistent. Otherwise, you might lose it somewhere. So you can either do all your console new accounts on your top level, because your eliminating entries is never going to affect your holding company. So it is okay if that's on your top level, or you can do it in your holding company. It really doesn't matter. I've also seen some clients that chooses to create a new entity, and the only things that they have in there is their journals. So it doesn't matter which one you do. I would just think it would be good practice to have it consistently in one or the other. So I'm going to do it on the top level there, and I'm going to say new one. So I might have more than one, and I'm going to create it, and I'm going to call it goodwill. And if you want to, you can put it the back console or something like that if you feel like you're going to forget, or you want to be sure that you know those all your console accounts. And then I'm going to make sure that it is mapped. I'm going to go to goodwill, and I'm going to go to cost, and I'm going to say, okay. So that's my first eliminating entry that I've passed. I'm going to leave it there for a second, just if anybody else wants to pause it to make sure it looks the same. If you don't see the drop down here with the different names, then it might be that you're still on that level. So if I now select F1, for example, you might not be able to see it. So just make sure that you've got your top one there, that you see all of them there. In the meantime, I'm just going to open my financials that the goodwill comes in, and I just want to close it so that that can refresh, because it seems like that console figure is not pulling in. So you can pause that journal, and if you want to, you can continue with the last journal, the loans one, and it's just to play around there. So it is in between the different entities. So with consolidations, as you all would know, there's certain journals that are kind of normal in a console. You normally have your acquisition journals, which stays the same each year, depending if it's maybe a new acquisition or a new investment, but they stay the same. And then you have some journals that change. One of them are the loans, because they need to eliminate, but the figures will change each and every year. So you'll have your loans. If you had intercompany sales, those might change each and every year. So at acquisition normally stays the same, except if there's a change, your other transactions and your balances might change as well. Just going to open this on my other screen quickly to have a look at this. Okay, so I'm going to give you 5 minutes or so if you want to process the other journal. And I'm just going to open my financials in the meantime. If you're done, you can, just so that your goodwill comes in. Right, so like I said, there's different kinds of journals. There's the ones that's recurring and the ones that are not. Now you'll see that you have this recurring option here. Now, if I select this one, recurring, and then I click on advanced, Then what it does is I can actually make this roll forward into the next year. Now, this is a very, very, very useful tool if you have a lot of journals. And we have, I mean, I've seen console structures that's really like, it takes the whole night for the file to run because that's how many entities there are, like 200 entities with thousands of journals. So if you have that scenario, this might be a good option for you because it actually roll forward. So the first year that you're doing your file, your prior year you will obviously have to do, and your current year you will have to do. You mark them as recurring. As soon as you roll forward the file, these journals will already be in there. They will still show up on your screen. So meaning if you now want to go and change something, you can still go and change it. It's not like it's posted and you can't see it. It's just that you don't have to manually go and do it. Now you have a few options here. You have the exclude amount and you have the post income statements to retained earnings. So if you have, so your at acquisition journal, like this one, I will say roll forward into the next year. They stay exactly the same and I don't need to do anything with it. If I, however, want to have files that goes to my, sorry, I lost my train of thought there. If I have amounts that goes to my income statement and retained earning, or to an income statement and balance sheet account, in the next year, that income statement journal needs to go to retained earning. And then I will select this bottom one here so that it automatically rolls it forward to that. If I have my loan one that I use as an example, then I will use the exclude amount function so that it doesn't pull through the amounts. So what it will do is it will create the journal for you, but it will be without amounts that you can use. Right. So if you now are done with your journals, and I just want to quickly take you back to the document manager. If I go to my console worksheet, to that one, you'll see that the journals that you've processed now will be in this column here, and that is what will make up your holding company column. Okay, so that is how you will continue. So you won't have, your loans will need to eliminate, your investment in the subsidiaries should be null, and you should continue like that. Now, I was worried that we're going to run a bit out of time. So what I did is I created an import journal sheet for us. So again, if I go into my Excel, the second tab or the last tab called Journals 2, this is all your journals that you'll need for this consolidation. Now, again, this is a feature that's not only for consolidation. You can use this for any of your files if you want to import journals. And you can do, you just have to make sure that your format is correct. So you don't necessarily need it in this format, the column order, but you do need all these columns included. So what I'm going to do is I'm going to import all of them. So I'm going to delete the journal that I did as an example, just because it is part of these journals. But you can also just import this is your prior year ones and this is your current year ones. And that's why I said your year end date is quite important as well. So if you can either just do this year's or all of them, just make sure that you then don't have your current year ones in. So if I go to my journals, I'm just going to delete this one. And let me just open up my journals on the other side. And I'm going to go engagement, and I'm going to go import again. And I'm going to go Excel file. So exactly the same way how you import a TB. But here we have this drop down. I will go there and I will say adjusting journal entries. Again, feature that's available for any file that you have to do. I'm going to browse for my file just to make sure I've got the right one. And I want to import now sheet 3. So if you're following me, make sure that this is adjusting journal entries, select your file, worksheet 3, and I'm going to go next. So I'm going to untick the top row. I don't want to import that. I want to import all of my journals. So I want all of them, and I'm going to click on next. Now here, your type is important. This is eliminating. If you don't change it here, again, the journals will be imported, so you can also go and amend it here. Your date, financials, the rest you can leave like it is. If I go next again, then you have your columns. So let's start with the first one. I'm going to go a bit slower just because it is a little bit different than the TB that you've done before. So this one, is so you've got two drop downs here. The one is account details and the adjustment journal entry. So if I go adjustment journal entry and I go, this is my entry number, then I can go and select that. If you already had a journal, so I already had a journal 10 and now import a journal 10, it will automatically change this number to the next one. So it's not like it will override the journals that you already have. Then on the date one, again, right click, adjusting journal, and I'm going to select date there. And then what is very important here at the bottom is to make sure you choose your date format. So mine is that one. And then at the bottom, it will tell you your year, your month, your day. So this is quite important. I got it wrong yesterday when I practiced a bit. And then again, the journal will import. You might just need to manually go and change your date. Then the next one is your account details. So I've got account description. Then I've got here my account number. Here is my entity abbreviation. Again, this is why it was important when you did your console setup, but your entity abbreviations is the same as mine. Otherwise, it will create another entity for you, another layer, which you don't want. So you go entity abbreviation. Then this is my amount, my debit field. The next one is my amount credit field. Make sure untick to say the positive imports as credits because it's already in credit. And then you've got here, you've got your journal, and this is my entry description. So I'm just gonna go back. So the first one is your entry number, then you've got your dates, important that you select your format, account description, account number, entity abbreviation, important that your entity abbreviation agrees to your console setup. Then you've got your amounts, if you've got debit, credit, or one column, and then your entry description. So if you do a setup for your import and you don't have your entry description, those will just be blank. But you do need the number, the date, the account number, obviously the amount. And like I say, you can use this for any journals that you need to import, not only for consoles. You can click next, next, next. And then you'll again get the record layout file. So if you have, as a firm, an import format, what you can do is you can also have the layout file option, which means you have it already set up for you, and then you can import the journals and you don't have to select all the columns to make sure they're right. So you can also use this on a firm level if you want to make sure that it comes in. So you can click on import and you can click on OK. And then it'll just take a second for your journals to be in. Right, and if I then click on my drop down, you'll see that there's all my journals have now been imported. Now I want to ask you a favor, and if you are doing it with me, make journal 5, make that as an unrecorded, as well as journal 6. And I'm going to show you now why. So all your journals are now in. If I go to my document, my console worksheet, I can see that all these eliminate. I've got goodwill there that makes sense. Investment in subs is null, should always be null. My loans are eliminating. So that all looks like it makes sense. Do you think I have an account that's not mapped? Because I can see here at the bottom there's a balancing. So let me go to account, assign mapping numbers. And then I can see there's 2 net ink accounts that is now come in with my journals, which isn't mapped before. So I've got my net ink for my income statement. Oh, sorry, not net ink, NCI. Income statement, which I can map under non-controlling interest. And then I have it under my equity as well. So in the group structure that I shared with you, I didn't put in the percentages there. But let's say that the one entity, I think it was, let me just see which one, I think it was F3, 20% is held by somebody else. So we only owe 80%. So the rest is all 100% owed. And that's why we have an NCI element. So I'm going to apply that. Let me also do my in net income while I'm here. Doesn't really matter, but just apply that. And we say yes. Right. And I'm going to click OK. And then I can see my NCI is now also here. So if I then look at my financials, I'm going to drag this quickly over. If I'm going to look at my financials, then I see my current year retained income is out. Now, it is very important to remember, although your TB's balance, and this is a question we get a lot, your subsidiary TB balances, my holding company TB balances, now why is my retained income out? Remember, your elimination entries can go to retained income, and that will then affect what is on your console side. So even if your TB's balance for your subsidiaries and for your holding company, if that retained income is out, it means there's a journal needed. And it is something that we get quite a bit. So if we look at this one here, just going to drag my Excel over. So if I look at my prior journals, you'll see I had my NCI for the previous years, which was 20 million. And then the NCI for the current year was 11,500. So, and how I got to the NCI, it was basically my profit, which if I go there, which was those two together, is my profit loss that I made for the year. And then 20% is 11,500. So I put through the 11,500. This might be the wrong way around, but it's the concept that counts. So now comes my next year, and I have now processed my acquisition journals. I've processed my loan journals, but I haven't processed these yet because I've asked you now to mark them unrecorded. It means that my retained income will be out because I haven't processed these. Now, why the top ones doesn't make a difference is because none of them go to the income statement or retained income, and that's why they don't have an effect on it. But these journals do. So if I look at my figures that's out, it's out by the 20 plus the 11,500, which is the 31,500, is what my retained income is out with. Because your retained income journals doesn't carry forward. I haven't marked them as recurring. They're not carry forward. If I did, it would already be balancing. So now if I go look at my current year journals, what needs to happen is I say, right, this last year was NCI and income statement and statement of equity. Now my retained income needs to be the 11 plus the 20 because this can't go to the income statement again. And my retained income will be the other side, which is the 31,500, your debit and your credit. So if you now go back into your journals that I've given you, that we've imported. So this will be, sorry, I'm in the prior, it was journal 5, yes. So journal 5 was this my NCI opening balance, and I want to say, right, I would want this one in, and that's the 31,500. And then what you'll do is for the current year, there's now the new NCI, which also need to be accounted for, which wouldn't affect your retained earnings in the balancing figure in the current year, but it will for in the future, and that's why you're processing that one. So you can mark them both as eliminating. Right, let me just quickly double check if there's any other questions here. I don't see anything else that I wanted to cover. I also don't see any questions. So important, just as to wrap up the console, your consolidation structure is important. Important not to have anything in the top company. Make sure if you do your setup that these ticks are right. If it's a roll forward especially, make sure that they are right. And then make sure that your column settings is set up. If you have that right with your journals, then you are 80% there. CPD certificates, if you do want your CPD certificate, you will get an email with it again at the end of the series. So it will be probably only at the end of April that you will get it, an email with it. If you do need it or you missed the email by end of April, you can also go onto the community and you can log in. And if you go to my training, you'll be able to download your certificates there. It's not there yet, but that's where you will be able to find it if you need it. I do also want to encourage you you've used the community now to get your get ahead documents, everything that you needed each and every week. But there is a wealth of information in there. There's a search, there's knowledge bases, there's FAQs, there's videos. So if you do struggle with anything, you've got that resource always available for you. Your online support is on there that you can also chat with. You've got your e-learning videos. You've got these videos that will be available. So all those resources are available to you. And then the recordings, like I've mentioned, we do have, we've got a YouTube page, KSV Africa. And then what we normally do, like this one's a bit to get off, but we have a video series then that we upload. So the first two is up, the other two will follow shortly, and you can always refer back to you. I see there's just a question about the recordings. I hope that answers your question. So that will be on the YouTube channel, and you're welcome to share it. The previous years are also there if you would want to go back, but in the financials, we have covered mostly and more what we've covered in the previous sessions. So I feel if you do 2026, you should be up to date. Right, and that is it from me. So that is a wrap. I want to thank each and every one of you for joining us. I hope it was useful to you, and I hope you can take this into your firm and on your job and really use it every day as you go along. So thank you and have a lovely day. Cheers.